What's up, YouTube? In this video, I want to talk to you about something I call the dark side of investing. And this is a topic that I don't think enough people online tell you about when it comes to investing specifically in the stock market. Of course, I'm a big advocate for investing. I think everyone should be doing it. And there are tons of positives that come with investing. And definitely it's important to understand, though, that there are some cons that come along the way. And understanding these cons and being able to navigate these cons is truly what can make or break you when it comes to investing. And again, I think some of these things that we're going to talk about in this video really aren't shared enough on social media. If you're someone that consumes a lot of financial content to try to reach your goals, I don't think enough people are talking to you about this, and this is why I really want to spend some time on this video. So we're going to go into what I consider the dark side of investing to give you a true full picture, a realistic picture of what you can expect, and also, of course, how to make sure that you're still successful at the end of it. Quick intro if you don't know who I am before we dive in. My name is Jose Hernandez. I have an online financial education company that serves first-generation wealth builders, people like you and me that are the first person in their family to start investing or start thinking about investing. And my goal is to help you reach your goal of financial freedom or build generational wealth for your family. I started my career in the wealth management industry as a financial advisor, where I got my Series 7 and 66 licenses, working with wealthy individuals, getting some mentorship from some of the top financial advisors in the industry, and eventually decided to move on and start my own thing and start sharing all the content that I've been sharing online for years now. So for today's video, some of this stuff I've covered often on my other channels, but I wanted to make sure that I had a YouTube video dedicated to this because I really want to go into depth into it. And I think the timing of the video is good too, because the market's been on a good run for the past 12 plus months. And I think it's important to share this message now and not just when we're in a bear market or things go south in the market. So let's dive in. So the thing that I want you to understand when it comes to investing is compound interest doesn't work how you might think it does. And let me explain this to you a little bit further. So you've probably seen something like this graph here, a compound interest calculator that says if you are investing such and such per month or per year, and you get this average rate of return somewhere around 8 to 10%, which is what the market's done over the past 100 years or so, this is what the wealth of your money is going to look like, or the growth of your wealth is going to look like rather. And while I do think this is a helpful exercise and the math can certainly work out this way, it's really important to understand that this is not how it actually works. The market doesn't just go up in a straight line. The market works in what's called cycles, which we're going to talk about a little bit later in this video. But while I don't think that you should not use compound interest calculators to calculate how much your wealth can grow over time, because I do think it's a helpful exercise from a planning perspective, and also it can give you a little bit of motivation to continue to invest or start investing. I also think it's important for you to understand that it's one thing to look at what compound interest looks like on a calculator online, and to also understand what it actually looks like when you're in the trenches in real life with money invested in the market. So I wanted to start there because, again, the stock market doesn't go up in a straight line. And that's a big misconception I think a lot of newer investors have, especially if maybe you started investing in the past 12 months or so, and we've seen nothing but pretty much good markets where the market is going straight up. Of course, that is a function of the market. There are periods of time where it does that, but I also don't want you to be disillusioned into thinking that this is how it works every single year or every single month, because that's just not reality. And you need to be prepared for the other side of the coin. So I want to show you a quick graph here. This is something I share with clients and students all the time. And we're looking at the long-term growth of, in this case, the S&P 500, which a lot of people consider to be the U.S. stock market. And of course, when you look at the long-term trend, the market goes up. And there's no reason, I believe, to not expect it to continue to do that because of how the market is designed and how capitalism works. But if you really pay attention to this graph, even though there is a long-term trend upwards, you'll see some periods of time that were really, really ugly for people that are investing in the stock market. The most recent one, of course, being the COVID pandemic, where the market dropped a ton really fast. It's the fastest that I've ever seen it drop in my career, and it was just a crazy period of time. But that's recent. We need to look even further back into history. Of course, there was the global financial crisis back in '08. There was a lost decade in the stock market from the 2000 to 2010, where the stock market really didn't grow. Black Monday, Vietnam War, there's inflation back in the 70s, the Cuban Missile Crisis. So these are all periods of time where you can see the red. The market dropped by a lot. So this goes back to the point that the market doesn't go up in a straight line. Yes, over time, it does grow and there's a lot of wealth that you can create through it. But the point of this video is to help you understand the dark side of investing. And the key is to be able to survive and not panic and not give up on investing when we see these periods of time in the stock market. So let me share a quick personal story with you how this actually, I've seen this in my career working with clients. So this was when I was just getting started in the industry. I was a young buck and I was working hard to build up my book of business and land new clients and do the thing. And this was back in 2018, where the market was actually, as you can see in this simplified chart, it was off to a really good start for the first, 2 to 3 quarters of the year. But then December happened. So if you weren't investing at this time or weren't really paying attention to this stuff, there's a lot of stuff going on about trade tariffs, like a trade war with China. There was concerns about the Federal Reserve raising interest rates. There was a lot of uncertainty in the economy. And the S&P 500 for the month of December dropped almost 10%. And this was an extremely stressful time for me as a young financial advisor because I was working crazy hours. I was working from 8 to 7, Monday to Friday. I was even working weekends as well. And I didn't have a chance to ever go see my family or anything because I was so focused on my business and working with clients. And I finally got a chance to go home for the holidays and the market just crashed. And I remember just not even being able to enjoy that time with my family because I was having to answer so many emails to clients and meet with them and make sure that they were not making emotional mistakes like panicking and shooting themselves in the foot. And this was one of the first times I actually realized, whoa, this stuff is real. It's not just a game. And of course, like the market always does, it recovered, and my clients were super grateful that I walked them through that and I talked them off the ledge, so to speak. But that was the first time that I noticed, okay, the market does not go straight up. Even though I already had that knowledge up here from going to school in finance, it's one thing to read about it in the book, but it's another thing to actually see it in real life when your actual money is at stake. And here's just a quick snapshot of the article talking about where the S&P 500 fell, excuse me, more than 9% in 1 month, which is a big drop for a really short period of time. So another thing to understand when it comes to the market in particular is it's actually really normal for the market to drop. And I know you see the Instagram posts and the TikToks and stuff like that that say, the market goes up and all that. And again, that is true. It's normal for the market to go up and the market should be going up. And if the market doesn't go up long term, we have much bigger problems. But the thing that people don't tell you is that it's actually extremely normal. And I want to emphasize the word extremely normal for the market to go down sometimes. And a lot of people don't understand that in advance and they start freaking out when they experience that. So let me show you some figures around this to make this a lot more clear. So a small correction around 5% drop happens basically almost every year. I don't want to say it's guaranteed, but you should expect the market to drop by 5% every year for the most part, right? So since 1980, the market has experienced a temporary decline of 5% or more just about every year. And on average, a 5% decline in stock market prices has occurred 4.5 times a year over that same period. So almost 5 times per year, the markets experience a 5% drop. So the next time you experience a 5% drop, you need to realize this is literally par for the course. This is what the market does. It's just as normal for the market to go down as it is to go up. Here's some more figures around that. So on average, over the past, close to century, the S&P 500, the U.S. stock market, has experienced a correction, which is a 10% drop once every 2 years on average, a bear market, which is a drop of 20% or more, which we've recently seen, once every 7 years, and a crash once every 12 years, a crash being a drop of 30% or more. So this goes to show, no, it's not going to happen all the time. It's not going to happen every year when we're talking about these bigger drops, but it is very common, especially if we're talking about investing for the long run, which you should be doing if you are investing. This is a guarantee that this is going to happen. Of course, it depends on how much the drop is and how long it lasts, et cetera, et cetera, et cetera. But I need you to understand that drops in the market, even big drops in the market, are very, very normal and they're part of investing. And one takeaway that I want you to kind of think about this is something that I think helps a lot of my clients and students that struggle with understanding how to emotionally deal with ups and downs in the market, is understanding that the stock market, kind of like the weather, works in seasons. Let me explain that a little bit further. So as you know, we have the spring season, summer, fall, winter, and then it circles back to spring again, summer again, et cetera, et cetera, et cetera. So the market also kind of works in seasons. So if you don't know terminology of the stock market, there's bear markets and there's bull markets. The bear markets are the bad times. It's like the winter where the market's down 20%. It might be down 20% for some time. And then we have the flip side. We have bull markets, which is basically what we've seen over the past 12 months or so, where the market's up 20%, it keeps going up. It's a great time for everybody. Both of these types of markets are normal. And a lot of people get stuck into thinking, especially during the good times, that the bull market's going to last forever. That's another reason why, in the story I just shared earlier, a lot of my clients were really freaking out because the market had gone up basically every year for the most part for almost a decade straight. And they forgot that the market is what's called cyclical. They forgot that the market works in cycles. And the biggest mistakes that you can make don't necessarily happen in the bull markets. They happen in the bear markets. And on the flip side, the biggest opportunities to invest and build wealth aren't necessarily in the bull markets. Yes, of course, you want to capture that growth and take advantage of it. But the biggest opportunities lie in the bear markets where people are afraid, where people are selling stocks, where the market is dropping and you can buy more shares and build more wealth when the market eventually recovers. Because as we know by now, or hopefully if you're paying attention, the market works in these cycles. This is another visual that I share with a lot of clients and students. It's kind of called like the market pendulum. So it swings back and forth based off of people's emotions. That's one of the main things that drives the market going up and down, is just how people are feeling. What's the vibe like? When there's a lot of fear, what are people doing? They're panicking, they're selling stocks, the value of the market's falling, and that's what causes bear markets and so on and so forth. And on the flip side, when people are excited, they're optimistic, they're buying stocks, they're causing the price of the market to go up. That causes a bull market. What's really important to understand is you don't want to get too caught up in either emotion. You want to take advantage of the growth. In the bull markets, you don't want to shoot yourself in the foot in the bear markets, because you really need to keep the bigger picture in mind. And understanding this simple but important concept really sets you ahead of the majority of people that are kind of just winging it with the stock market. They don't realize how the market actually works. And again, like I said, the biggest mistakes happen in those bear markets. So you're probably wondering, like, okay, now you're telling me like I can lose money in the stock market. Like, should I even worry about investing now? Should I just keep all of my money in cash where it's safe, where it won't go down? And of course, the answer to that is no, you should not just keep all your money in cash. You should still be investing, especially if you have very big, important goals to you, like financial freedom, like generational wealth, like a retirement by a certain age. You're not going to get there by saving alone. And what I want to really help you understand is, again, the biggest opportunities for investors, especially if you're what's called in the wealth accumulation phase, which is really that first stage of your investing journey. If you're building your wealth from scratch, essentially, some of the best times to be investing, if you're thinking long term and you have a good strategy and you know what you're doing, some of the best times to be putting money to work in the market is during these periods of time where everyone's afraid, where everyone is thinking the world's going to end, the market's never going to go back up. You know, all the stuff that you might have seen during COVID or even 2022, which was a really rough year. Those are the biggest opportunities if you're putting new money to work. And here are some statistics to look at that take into account past drops in the market. Some really nasty drawdowns is what the drawdown is the term for how much the market falls, basically, and the returns that happen after that. Because again, remember the market pendulum. The market shifts from fear to greed and back and forth. The market works in seasons. It shifts from winter to spring to fall to winter to spring to summer to fall. I don't know if I'm saying my seasons right, but you get the point here, right? So you'll see the returns after these big drops in the market are pretty big. And that's because the market works in cycles. The market goes up, it falls, it recovers, and it keeps doing that. Of course, like we looked at the chart earlier in the video, the long-term trend is certainly upwards, but you can't get caught up in what's happening over a 12-month period or even 2 or 3 year period. Because in terms of the stock market, that's really short term. And if you don't understand that, you're never going to make it, because you're going to get so caught up in the short-term thinking. You're going to get too greedy when times are good. You're going to get too fearful when times are bad. And like that Warren Buffett quote says, you want to do the opposite of that. You want to be greedy when others are fearful and you want to be fearful when others are too greedy. So just wanted to give you some visuals to look at here. You can pause the video if you want to zoom in and look at these percentages here, but some really big returns are to be had during periods of time where people are giving up on their investing and they're like, well, I'm never going to invest again, or it's too risky or whatever. And these are the things that if you're a first generation wealth builder, you were probably told growing up in your home. I remember people in my house saying investing's too risky, just try to save money, et cetera, et cetera, et cetera, because they were so caught up in the short term and they didn't have that deeper level of understanding when it comes to how the market actually works and how wealth creation through investing works. And that's a big thing that I want to drive home in this video. So to wrap this video up, I really want to help you understand a couple key things. Number one, investing is not always going to be an easy ride. It can be a difficult ride, and there's going to be some periods of time of uncertainty. There's some times where the markets can be down big, like 2022 was a more recent year where the market just sucked. There's no other way of putting it. It was a rough year to be invested in stocks. 2008 sucked. There's a lot of periods of time in the market, even in recent history, that make you wonder, is this thing even worth it? And of course, the answer is yes, it's worth it. It's definitely worth it. You're not going to save your way to financial freedom. You're not going to save your way to early retirement. You're not going to save your way to generational wealth. It's really important to start developing the skill of investing and also the emotional intelligence that you need to be able to avoid making those big mistakes, especially when things get a little bit choppy in the market. And this topic that we're covering today is important whether you have $0 invested right now or you have several millions of dollars in the market invested right now. And it becomes even more important the larger that your wealth grows, because that's where the losses get much bigger in terms of dollar amounts. And that's where you make the biggest mistakes that can really set you back years when it comes to your goals. And the key here is, of course, education, just having the right knowledge as it relates to how investing works, having the right strategy that you're comfortable with, that you can stick to through ups and downs in the market, and having clear guidance and direction to help you reach the goals that you have for yourself and your family, whether the market's up, down, or sideways. And that's why I spend so much time with clients and students on this topic in particular, because this is literally what can make or break you in your investing journey. So really important to understand. So next steps are, if you're watching this video and you know investing is important, you know it's something that you should be doing, maybe you've already been investing for some time now, or you haven't got started and you just don't know how to start, or again, if you've been investing for some time now, but you're worried that you might shoot yourself in the foot, you don't know if you're investing enough, you don't know if you're on track, if you own the right investments, if you have all these questions and you want that sense of confidence and peace of mind when it comes to reaching that goal of financial freedom for yourself, for your future, next steps are in the description to this video. You're going to see a link that you can use to schedule a one-on-one call with myself. It's an opportunity for us to sit down, help me understand more about your situation, help me understand some of the things that you're struggling with. That way I can point you in the right direction and help you feel a lot more confident about reaching that goal of financial freedom or generational wealth for your family. So again, the link to that excuse me, is in the description to this video. So you can click on that. We can schedule a time to meet. Excuse me, I need some water. But this video, hopefully you found it helpful. Again, I hope the timing of it is good, especially with the recent run that we've seen in the stock market. If you do find this video helpful, make sure that you give it a like, subscribe to the channel so you can get updates as to when I make more videos just like this, and also leave a comment down below because it helps the video get pushed to more people. But again, hope you found this helpful. That's going to be all for me in this video. Really appreciate you taking the time to watch this. Share it with a friend if you think that would help them in their journey as well. But thanks again for watching, and I'll see you in the next one.